how professional traders trade in the Forex market using smart money concepts, supply and demand, liquidity, and precise models like order blocks and fair value gaps is not what most people think. In this video, you will learn how to apply these concepts the right way and why understanding how the market really works is essential. You will understand structure, liquidity, and execution step by step so you can stop guessing and start trading with a clear and professional framework. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let us begin with the first and most important step, defining the trading range before doing any other analysis. The starting point is straightforward. Before looking at liquidity, fair value gaps, or market direction, you must first determine the current trading range. So, what exactly is a trading range? It is not simply a box or a period of consolidation. A trading range represents the active area where price is moving and where liquidity is continuously forming. In simple terms, this zone provides the clearest insight into where price is most likely to move once it breaks above or below the range. And while price remains inside that environment, close attention to price action becomes essential. So how do you properly identify the current trading range? The first step is to zoom out to at least one or two higher time frames compared to your execution time frame. For example, if you enter trades on the 1-minute chart, your range should be defined on the 15-minute chart. If you trade on the 5-minute chart, look to the 15-minute, 30-minute, or 1-hour charts. If your execution time frame is the 1 hour, then your trading range should be taken from the 4-hour or the daily chart. This is a crucial rule. Never define your trading range using the same time frame you use for entries. To establish a proper trading range, the first step is to find the most recent valid and confirmed break of structure impulse leg. In this example, the break of structure is considered valid because before price continued higher, it pulled back into the discount zone, trading below the 50% Fibonacci level and activating resting buy orders. Next, our attention shifts to the impulse expansion leg that produced this confirmed break of structure. Later, when price moves below the most recent internal low located in the premium area, which serves as inducement, two confirmations occur simultaneously. First, the bullish expansion leg is complete. Second, this swing high becomes the upper boundary of the trading range. This sequence is what defines a valid trading range. You may wonder why we do not treat this single impulse move from the swing low to the swing high as the trading range. The reason is simple. When you apply the Fibonacci tool from the swing low to the swing high, you will see that price never retraced to the 50% level of that impulse. This means discounted buy orders were never filled. As a result, this move does not qualify as a valid break of structure. The breakout is misleading, and the range formed from it is not a valid trading range. This pullback is simply a short pause while price prepares to complete its true impulse leg. For a trading range to be considered valid, price must break below the most recent internal swing low, which acts as inducement, confirming that the bullish expansion has ended. Only at that point do we have a legitimate trading range that can be trusted. Once your trading range is clearly defined, you stop chasing breakouts. You stop buying at highs and selling at lows. You stop trying to predict direction. Instead, you wait for confirmation, such as liquidity sweeps, inducement, or a clear shift in delivery. This is where high probability trading truly begins. The next step is understanding where liquidity actually sits and how it is defined inside and outside the trading range. When you understand internal and external liquidity, you no longer ask whether price is bullish or bearish. Instead, you ask which pool of liquidity price is likely to target first. That single shift in thinking changes everything. To understand this properly, we need to step back and see where that liquidity actually comes from. When price moves within a consolidation or any structured phase in the market, it often forms visible reference points such as equal highs, equal lows, trendline touches, or repeated reaction areas before the next major move begins, whether that is continuation or reversal. Within these structures, we typically observe zones where price consistently reacts, forming areas of support below and resistance above. Retail traders typically look to buy when price approaches a lower boundary or a perceived support area, placing their stop losses just below it. This creates a concentration of orders beneath that zone, made up of the stop losses of buyers, ready to be triggered. In addition, it often includes sell stop orders from traders expecting a breakdown, believing price will continue lower once that level is taken. On the opposite side, when price approaches an upper boundary or a perceived resistance area, many retail traders look to sell, placing their stop losses above it. At the same time, buy stop orders begin to accumulate from traders expecting a breakout. This creates another concentration of orders above the structure, with multiple types of positions clustered in the same area. Therefore, buy-side and sell-side liquidity do not exist only at traditional support and resistance levels. They form wherever there is a concentration of orders in the market. Buy-side liquidity refers to areas where buy orders are clustered, often above highs or key reference points, while sell-side liquidity refers to areas where sell orders are clustered, typically below lows or areas where traders expect breakdowns. Now, let's take a closer look at how buy-side and sell-side liquidity appear in the market through what we call static liquidity. Static liquidity refers to specific areas in the market where a large concentration of orders is resting, including stop losses as well as buy and sell orders waiting to be triggered. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop. This is part of how liquidity is created and taken from the market, allowing price to continue moving. The idea is simple. The market requires liquidity to generate movement. If price does not interact with liquidity before reaching a key level, it will often use that area itself as a source of liquidity to fuel the next move. Static liquidity can be identified in various areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within other important reference areas where traders tend to place their orders. These also include commonly observed zones, such as support and resistance, Fibonacci levels, and key regions within a candle structure. What matters is not the tool itself, but the fact that many traders are making decisions around those same levels. Having a clear understanding of these liquidity zones highlights how strongly they influence price movement. Some of these areas become especially important because they are widely recognized, attracting more stop losses and pending orders, which increases the probability of price moving toward them. Next, we examine how the market responds when it approaches these zones. Suppose price is moving toward a visible area where many orders are likely to be resting, and traders begin positioning themselves based on that expectation. If price pushes beyond that level, it triggers those orders, creating a surge in activity as positions are forced to execute. This reaction generates momentum and often leads to a sharp movement as liquidity is being taken from that area. These behaviors can appear in any type of market structure. The key idea is not the specific pattern, but the presence of clustered orders. Understanding where these concentrations form allows traders to better interpret price movement and anticipate how the market may react when those areas are reached. In simple terms, the market moves from one area of liquidity to another, driven by orders being triggered and absorbed. By understanding buy-side and sell-side liquidity, you begin to see the market as an interaction between buyers and sellers. And once you understand how that liquidity forms, the next step is to see how it is structured within the market. Because not all liquidity is the same. Some of it sits inside the range, and some of it sits outside, and each plays a different role in how price moves. So let us begin with external liquidity. External liquidity is found outside the trading range. It is typically located above major swing highs or below major swing lows, precisely where retail stop losses tend to sit. These are the zones smart money exploits to manipulate price. The high and low of your trading range are the most critical external liquidity levels to monitor. The reason is simple. They represent the nearest pools of external liquidity relative to the current price, and price is far more likely to seek one of these levels first before any other objective. Remember this: most market manipulation takes place around external liquidity, particularly near major session highs and lows. You can think of external liquidity as one pole of a magnet, but a magnet cannot function with only one side. The other pole is internal liquidity. Internal liquidity is found within the trading range. This is where the majority of meaningful price behavior develops. It is where inducement is formed, traps are engineered, and positions are accumulated before the true move unfolds. Internal liquidity commonly shows up as fair value gaps, volume imbalances, liquidity sitting above or below internal swing highs and lows, internal trend lines, and consolidation zones that develop inside the trading range. Put simply, internal liquidity includes all liquidity that exists within the current trading range. And this is the key takeaway. Internal liquidity is not designed to be the final objective. It is meant to be used. Smart money consistently leverages internal liquidity to drive price toward external liquidity. And this is exactly why understanding it is essential. The relationship between internal and external liquidity is what powers the market's core algorithm. But once you understand where price is likely to move, the next question becomes unavoidable. Where exactly should you enter? Because knowing the direction is one thing, but executing at the right level is what separates traders who understand the market from those who consistently profit from it. And this is where most traders struggle. They can identify order blocks, they can mark fair value gaps, but they do not understand which one price is more likely to respect under specific conditions. So, instead of treating these zones as isolated entry tools, we need to understand how they function inside the liquidity framework we just discussed. Let us break this down in a practical way. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. Now, let us break down what is happening in this example. The market was moving in a downtrend until price shifted direction, pushed higher, and after removing the inducement level, finally produced a change of character by breaking and closing above this major high. With that change of character signaling a potential bullish trend, our focus shifts to finding a place to enter long. So where should we look for a long entry on this chart? But before we move forward with order blocks or fair value gaps, we need to pause and understand one critical element. What exactly was that inducement level that price removed? Because without understanding inducement, you will constantly refine entries at the wrong place and miss the real point of interest. At its core, inducement is the process of creating liquidity before the real move takes place. It represents the final pool of liquidity engineered to fuel the intended move, and it can appear in several different forms. The most common are structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all these variations, structural inducement is arguably the most important because it occurs directly within market structure and creates patterns that traders encounter almost every day. A structural inducement happens when price generates a false structural signal, such as a fake change of characters or a misleading break of structure, encouraging traders to enter too early or position themselves in the wrong direction. In this example, price is trending higher and continues producing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, everything initially looks completely legitimate. Price breaks above the swing high and closes beyond it. Naturally, this leads many traders to anticipate buying opportunities at the demand zone or order block responsible for that break. Then the result becomes obvious. You enter the buy position and price quickly stops you out. This is a classic example of how structural inducement traps the majority of market participants. The reason becomes much clearer when we take a deeper look at what actually happened. This so-called break of structure was never a genuine break of structure in the first place. The entire move was driven by resting buy-side liquidity located below, inside the discount zone of the primary bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price never even retraced to the 38.2% level, let alone the 50% level of the previous impulse. This observation is extremely important. For us at ComLucro, any retracement that fails to reach at least the 38.2% level should not be considered a valid retracement. And even when price reaches only the 38.2% level, these shallow pullbacks often lead to inducements and liquidity grabs rather than clean, high-probability entries. Because of this, traders should always approach shallow retracements with caution. In a bullish trend, the preferred scenario is to wait for price to retrace toward the 50% level or even deeper, where price enters the discount zone. This is where institutional buying activity is more likely to be present and where you reduce the risk of becoming liquidity for inducement-driven moves. Now let's move on to the second type of inducement. Liquidity-based inducement is by far the most common form of inducement you will encounter in the market. It occurs when price deliberately creates a new high, a new low, or even a small order block or breaker that appears exceptionally clean, with the sole purpose of attracting traders into the wrong position, collecting liquidity, and then delivering the real move. And this process takes place every day across all markets and all time frames. The primary objective behind this behavior is to create stop losses that smart money can later use as fuel. By encouraging retail traders to position themselves on the wrong side of the market, their stops become a source of liquidity that can be collected before the true move begins. This is why you often see a small high form before a bearish move, a small low form before a rally, a false breakout before a reversal, or equal highs and lows swept by only a few pips. These events are not random. They are examples of liquidity being deliberately engineered by smart money. Now let's move on to the third type of inducement, time-based inducement. Time-based inducement occurs when the market creates a trap move during periods of elevated trading activity, most commonly right before or immediately after a major session open. This form of inducement is particularly powerful because it appears consistently day after day and provides traders with some of the best opportunities to develop a structured trading plan while staying aligned with institutional order flow. At this point, you may be wondering why this type of inducement occurs so frequently. The answer lies in what happens during major session openings. Several important factors come together at the same time. Fresh liquidity enters the market. New order flow is injected into price almost instantly. Retail participation increases significantly, and smart money takes advantage of these conditions to manipulate price, create a misleading move, trap traders on the wrong side of the market, collect liquidity, and then deliver the true move that was planned from the beginning. Now that we understand how liquidity is engineered before the real move, let us return to our original example. So where should we look for a long entry on this chart? The first step is identifying the discount zone, which contains both the higher and lower time frame order blocks inside it. If your goal were simply to participate in the move using the higher time frame order block, you could have placed a buy limit at the top of that order block with the bottom of the zone acting as your stop loss. This would have placed you in the trade, and price likely would have moved upward after triggering your entry. However, this type of entry comes with a wide stop loss, which reduces the reward-to-risk ratio and increases the potential damage if the trade turns against you. If your goal is to work with a tighter stop loss and a stronger reward-to-risk ratio, then your entry zone needs to be refined. This is why many traders shift their focus to the extreme lower time frame order block at the bottom. At first glance, this seems like the ideal choice because it offers a very small stop loss and naturally delivers a high reward-to-risk ratio. However, if the extreme lower time frame order block were tapped every time, the market would constantly retrace deeply, creating a zigzag pattern on every swing, which simply does not reflect how price behaves in real conditions. So what is the practical solution? In many cases, order blocks will not be respected. What tends to happen instead, especially on the lower time frames, is that the fair value gap becomes the zone that price reacts to most consistently. With that in mind, we can now combine the concepts and evaluate what price is most likely to respect when approaching order blocks or fair value gaps under different contexts. But selecting the right zone is only part of the equation. The real edge comes from understanding how liquidity is drawn, how it is cleared, and how execution should be structured around that sequence. But what exactly is a draw on liquidity? It is the process of identifying a significant liquidity level that price is clearly moving toward. In practical terms, the market frequently gravitates toward areas where resting liquidity exists, such as equal highs, equal lows, or clearly defined swing highs and swing lows, because that is where clusters of pending orders are waiting to be executed and filled. You want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there, and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. Now let's connect this back to the liquidity framework we've been building. If execution depends on liquidity and structure, then the next logical question becomes, which zone is price more likely to respect under different time frame conditions? On higher time frames, such as the 1-hour or 4-hour chart, price generally shows a stronger reaction to order blocks rather than fair value gaps. But when we move down to the lower time frames, price is far more likely to respect the fair value gaps instead of extreme order blocks positioned at the outer edges of the move. So let us imagine that price forms a structure like this on the lower time frame. As mentioned earlier, on time frames such as the 15-minute or 5-minute chart, price is much more likely to react to the fair value gap that appears above or below the order blocks and reverse from that gap before reaching the extreme lower time frame order block. Using lower time frame fair value gaps as entry points can be highly effective. Entries based on fair value gaps tend to produce a higher activation rate compared to relying solely on extreme order blocks. In a bullish scenario, this usually means placing your limit order at the highest point of the fair value gap, while positioning your stop loss beneath the extreme order block. The trade-off is that this creates a wider stop loss, and that naturally reduces the reward-to-risk ratio of the setup. Placing a tighter stop loss just below the lowest point of the fair value gap is also possible. The challenge with this option is that it exposes the trade to greater risk. The extreme order block sitting below the fair value gap may still attract price, pushing the market downward and triggering the stop loss. So even though a tighter stop may look attractive, it is important to weigh the additional risk before applying this adjustment. As mentioned earlier, on higher time frames, our main focus is placing entries at order blocks. Traders can still choose to rely only on order blocks in the lower time frames as well, but doing so often results in missed opportunities because price does not always return to those extreme levels. Now, we have already covered the scenarios in which price respects order blocks, respects fair value gaps, or interacts with both. However, there is another situation you may encounter in the market, one where price respects neither the order blocks nor the fair value gaps. Let us explore this scenario and understand the main reason behind it. You have likely experienced moments when you spotted an excellent setup and a strong opportunity to enter the market after all the rules of your strategy were met. You marked your ideal entry zone, set your pending order on the fair value gap or order block, and waited with confidence for price to return. You felt ready for the perfect trade, yet price simply continued moving in the intended direction without ever triggering your limit order placed at the extreme of the gap or order block. In the end, the trade played out without you. The main reason price behaves this way is the level of inefficiency it creates while attempting to retrace toward the fair value gap or order block positioned at the extreme, When price forms a large inefficiency on its way to those zones, it leaves behind significant liquidity voids. As a result, the market often pauses to fill those voids before continuing. This behavior highlights an important principle. Markets do not simply move from zone to zone, they move through liquidity sequences. And when we understand that sequence, execution becomes far more precise. This same logic is structured and repeated every day in specific intraday models, such as the silver bullet. The silver bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. When these elements align within specific trading sessions, they create a structured opportunity based on liquidity and confirmation rather than random entries. To trade the silver bullet, wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This movement above a key intraday level attracts breakout traders, but the fast return inside the range signals that liquidity has been collected. This liquidity sweep above the key structure of the day suggests that a potential reversal may be forming, especially when it occurs during high-volume session times. Next, we wait for a bearish market structure shift to confirm this potential reversal. A bearish market structure shift happens when price breaks and closes below the most recent swing low. This shift indicates that buyers are losing control and that selling pressure is beginning to dominate. In other words, demand is no longer in control, and price may start pushing to the downside with stronger momentum. Then mark the bearish fair value gaps that form during the displacement move as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into that area. If new fair value gaps form as price continues to move, you can map out future opportunities. But always follow a clear and disciplined risk management plan to protect your capital. Similarly, in the bullish scenario, the logic simply inverts. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid liquidity sweep pattern forms when price breaks below a key level and then immediately returns back inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, remember to use a slightly wider stop loss to give the trade enough breathing room and protect it from normal market fluctuations. Now, let us bring this back to our broader discussion. Whether we are analyzing intraday models like the silver bullet or higher time frame order blocks, the underlying principle remains the same. Liquidity is cleared first. Structure shifts. Execution follows. If we examine this example on the euro-dollar pair, we can see that the market is in a downtrend and has already confirmed a bearish break of structure by breaking and closing below the most recent major low. There's an order block resting at the extreme, and just beneath it, we can identify a fair value gap. Both areas could be used as potential entry points. As price retraces downward toward these zones, we notice that it reverses before reaching either one. The reason for this shift lies in the inefficiency created during the retracement wave, which prevents price from traveling deeper into our marked levels. Let us look at a more general trading example that brings together the concepts we have discussed throughout this episode. On the screen, we have the euro-dollar 15-minute chart. We can see that price moved lower and mitigated the 1-hour demand zone located beneath the liquidity pool created by the equal lows. When we zoom into that area, it becomes clear that the higher time frame demand zone was respected. After this mitigation, price pushed upward and, once it cleared the inducement level, broke and closed above the most recent major high, forming a valid change of character. From here, our next step is to search for potential long entries. The first opportunity would have been at the order block positioned at the extreme. If that entry was missed, then the question becomes where to enter next. Price has made another bullish run to the upside and has now produced a bullish break of structure, confirming that the direction has shifted to bullish. At this stage, we have two possible entry methods to evaluate. The common approach many traders take is to rely on the extreme order block. In this scenario, there is an imbalance that must be filled, and the order block sits directly beneath the fair value gap. The strategy would be to wait for price to retrace into the order block, trigger the buy limit placed at the top of that zone, and then climb higher from there. In the second option, we're considering entering the market from the fair value gap area. This approach is commonly seen in lower time frames. When entering from the fair value gap, it's important to consider a key point. You could place your entry at the highest point of the fair value gap and set your stop loss just below the fair value gap area. While this strategy can be effective at times, it's important to note that your stop loss will be very tight. Additionally, since we have an unmitigated order block at the extreme, there is a possibility that the price could push downward to fill it. So I recommend keeping your stop loss a bit wider by placing it beneath the order block. The whole point of this type of entry is to reduce the possibility of missing a trade, although it does reduce the reward to risk ratio. Now let's consider what would have happened with both of the trades. For the first option, if we had waited for that order block, this is what would have happened. Let's say that we already had our take profit set at this high. It's clear that we would not have entered this trade since the price couldn't activate our buy limit order. If we had entered from the fair value gap, our buy limit order would have been activated and our take profit would have been hit by the price. We can see that the trade played out without pulling back to the extreme order block. And this highlights a key principle. Markets do not simply move from one zone to another. They move through liquidity. And once your execution is aligned with that process, the next step is to understand what actually drives price from one level to another. Because liquidity is not static. It is constantly moving, evolving, and shifting as the market develops. And this is exactly where most traders start to lose clarity again. So the next step is understanding how the market operates beneath the surface through dynamic liquidity. Internal and external liquidity together make up what we call dynamic liquidity. This is the true engine behind price movement, driving price higher, pulling it lower, or misleading traders along the way. Dynamic liquidity explains how liquidity continuously moves and evolves throughout the market. Think of it as a cycle. Price is always rotating between internal liquidity and external liquidity. It moves either from a high or a low toward a fair value gap, or from a fair value gap back toward a high or a low. This rotation represents the fundamental rhythm of price behavior. Once you recognize that rhythm, your perspective shifts completely. You stop resisting the market and begin aligning with it. Dynamic liquidity is the force that pulls price forward, and understanding it gives you a strong edge in anticipating both direction and timing. Within a trading range, price typically targets internal liquidity first. That internal liquidity may take the form of internal highs or lows or fair value gaps. As price approaches these internal objectives, inducement develops. And once that internal liquidity is taken, or the imbalance inside the fair value gap is filled, the market's attention turns outward. At that stage, price begins seeking the next external liquidity pool to expand into. When this occurs, previous liquidity is cleared, new liquidity is formed, and price becomes attracted to a new external target. That fresh draw is dynamic liquidity in action. So, if you are buying or selling inside the range without understanding this process, you are most likely doing one thing. You are providing liquidity, not taking it. This cycle plays out again and again across every time frame. Once you understand dynamic liquidity, you stop holding positions for too long. You stop aiming for invalid highs and lows. You stop forcing a directional bias. Now, we arrive at the real challenge. You may be wondering how to determine where price is likely to go next. Will it push higher to take upper external liquidity, or drop lower to collect sell-side liquidity? To answer that, we must pay close attention to how price reacts when it enters fair value gaps inside the trading range. This is where directional clarity starts to form. When price trades into a fair value gap, respects it, and especially holds the midpoint while showing rejection to the upside, It is a strong indication that price is preparing to move higher, targeting upper external liquidity. On the other hand, when price shows no respect for the fair value gap and drives straight through it without a meaningful reaction, that gap changes its function. It becomes what we call an inverse fair value gap, now behaving more like a resistance area. Finally, we need to understand liquidity sweeps and how they reveal true market direction. A liquidity sweep focuses on one simple concept. Price runs liquidity above or below a key level, then quickly closes back inside that level's range, and from there drives toward liquidity on the opposite side. For example, when price sweeps a key buy-side liquidity level, we expect a rapid shift in direction, with price moving toward sell-side liquidity at the opposing key level. This is one of the most effective liquidity models because the market repeats this behavior every single day. It provides a clear framework for building a structured trading plan and aligning with institutional flow, instead of trading against it. There are two primary types of liquidity sweeps. The first is a sweep of major external liquidity levels. These offer the highest probability setups and should always be the main focus. The second type is a sweep of internal liquidity levels. These carry much lower probability and are where most traders get caught in false moves and inducement traps. High-quality liquidity sweeps tend to form during periods of elevated volume, most commonly just before or immediately after a major trading session opens. In this example, you can see that right at the session open, price makes a false move to the upside, sweeping the liquidity that formed above the Asia session high. Right after that buy-side liquidity is taken, price sharply reverses and moves in the opposite direction, also taking out the Asia session low. In this sequence, price removes both buy-side and sell-side liquidity before continuing in the direction it originally intended. If you pay close attention, you will notice the same behavior repeats at the New York session open. Price pushes above the London high, clears the buy-side liquidity resting there, and then quickly shifts direction toward the next major sell-side liquidity level, which is the London low. From that point, the market delivers the true move that smart money had planned from the start. We also see liquidity sweeps occur at internal swing highs or lows within a trading range. These are not genuine liquidity sweeps, and in most cases, they result in low probability trades. The explanation is simple. The most significant liquidity is positioned above and below the high and low of the trading range. Because of this, price is far more likely to seek external liquidity rather than internal swing points. For that reason, our focus should always remain on liquidity sweeps at key external levels, not just any internal high or low. There is one important exception that can create a high-quality trading opportunity. When price sweeps internal liquidity just before reaching an unmitigated fair value gap on the opposite side, the probability of a strong move toward the next external liquidity pool increases significantly, especially when it aligns with the higher time frame trend. In this situation, internal liquidity acts as fuel, not as the final objective. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader Community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.